The 4% rule says you can withdraw 4% of your investment portfolio at retirement, and then adjusted for inflation, you won't run out of money. It's an interesting concept, but should retirees use the 4% rule for retirement planning? Absolutely not. In this video, I'm going to give you 7 reasons that it should be ignored. One, it's a moving target. Since being published, the creator of the rule, William Bengen, has updated it numerous times. Most recently, he suggested 5% was fine and that 4.5% would be a worst case scenario. Then it became 4.7% and then 4.4%. If you're a long way from retirement, the number will most certainly change by the time you get there. 2, history needs to repeat itself. The problem with using historical data and projecting it into the future is that it assumes that history will repeat. Stock markets are a relatively new invention in the history of humankind. 100 years is a blip in the grand scheme of things, and we don't have multiple universes of data to draw from, only that produced by us Earthlings. The future is certainly going to look different than the past, and there's no guarantee that portfolio returns will repeat. 3, your portfolio matters. The 4% rule is based on a portfolio of 50% large cap US stocks and 50% US government bonds. It assumes that investors stay balanced, meaning they never deviated from that asset mix. But even William Bengen doesn't hold the same portfolio over time. For example, he recently suggested that investors should have half their portfolio in cash. Most investors are unlikely to hold the exact same portfolio for 30 years and remain perfectly balanced at all times. And your portfolio likely isn't half US stocks and half US bonds either. 4, what about Canadians? Canadian investors should be holding a globally diversified portfolio. But the study is based on only US markets in US dollars. Even if you did hold a 100% US based portfolio, and you shouldn't, you're likely going to convert it to Canadian dollars when you spend it. That adds currency risk, meaning the performance of the US dollar will directly impact your portfolio returns and your safe withdrawal rate. It could benefit you, it could not. Nobody knows. In a 2017 study, Morningstar Canada looked at the historical safe withdrawal rate for 20 different developed countries. Assuming a portfolio of 50% domestic stocks and 50% domestic bonds, the safe withdrawal rate with a 95% success rate varied significantly across countries. In Japan, for example, it was only 0.2%. In the UK, it was 2.8%. The 20-country average, including the US, was only 2.3%. This alone should be enough for you to discard the 4% rule. But if you're not convinced, keep watching. We're only halfway there. Number 5, you are not average. While averages can be helpful, you are not the average. You are just a data point that contributes to the average, meaning your experience will certainly be above or below that average. In the data, there were periods where a 4% withdrawal rate meant that you would have run out of money. Anybody who experienced this probably doesn't care that their withdrawal rate was safe on average. Number 6, how long are you going to be retired for? The 4% rule was derived from a 30-year time horizon. With many investors these days aiming for early retirement, and combined with increasing lifespans, you may be looking at a withdrawal period of more than 30 years. Granted, it might be less than 30 years, in which case a higher withdrawal rate will be sustainable, but you won't know until it's too late anyways. Number 7, what about taxes? There were no taxes considered in the study, but most Canadians will have RSPs and TFSAs, with RSPs likely to represent a larger base of your retirement assets. Assuming a 30% tax rate, a 4% RSP withdrawal leaves you with just 2.8% of your RSP balance to spend after tax. On $1 million portfolio, that's a $12,000 difference per year, $1,000 a month. The same investor funding the retirement entirely with TFSAs would have a very different outcome. For most, it'll be a combination of taxable and tax-free retirement income. So the 4% rule tells you nothing about how much you can actually spend in retirement, which is the number that really matters. So, what should you do instead? Withdrawing 4% of your portfolio each year, adjusted for inflation, might be too much, and it might actually be too little. Flexible retirement spending strategies can help you overcome the shortfalls of the 4% rule. For example, cutting your spending in response to changes in the markets and inflation provides you with defense against running out of money. During a market decline, you can take either a temporary or permanent pay cut. This reduction means less impact on your portfolio from withdrawing money while markets are down, and leaves more to participate in the eventual recovery. So, if you must use the 4% rule as a guideline, understand its shortcomings. While it's better to have a target to aim at than no target at all, your target should be yours, based on your unique circumstances. As always, if you found this video helpful, please share it. And if you'd like to get in touch, you can send me an email or reach me at Mark McGrath CFP on LinkedIn and Twitter. Thanks.